Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I want to talk about the methodology in action, and I was thinking right before I went live here, that's probably the most important thing that I could show you. Actual trades that I have found, recommended, and taken myself. Along those lines, I'm showing my next 100 trades, and that'll make a lot of sense in just 1 minute. I'll explain that further too. We have a mystery chart reveal from a few weeks back, and I want to do a brief TFM 10% system update since the market really hasn't improved that much. Trading Psychology Crash Course Part 2, that'll make sense in 1 minute too. And then housekeeping, I do take requests. If there's something you want me to cover, it makes my job a lot easier. And if I can't fit it in this venue, I do a show most Thursdays, and you can go to davelandry.com/webinar for that. And that show's a little bit more open-ended, meaning that I can kind of get a little off topic and spend a little bit more time going maybe into a deep dive in some issues, especially if they're a little bit more complex. But anyway, shoot me an email at davelandry.com/contact for more on that. If you want the slides from this presentation and all the other presentations, go to davelandry.com/StockCharts. I'll also give you enough stuff to keep you busy for a long time. The weekly webinar on Thursdays, Dave Landry's Weekly Charts, can be found at davelandry.com/webinar. Register even if the date is old on that. And you can reach me at davelandry.com. I'm sorry, at Dave Landry, TRDR is my Twitter handle. All right, let's talk about the mystery charts and the methodology and action. Now, someone was pointing out that some of the stocks I'm showing in these presentations are cherry picked, and the reality is they're really coming straight off my trading service and coming straight from the things that I've recommended and straight from the mystery charts that I've showed prior. But what I said was, look, I tell you what, I'll just go ahead and show you my next 100 trades. There's going to be zero hindsight. And again, most are from the mystery charts, which usually come straight from the trading service. If I do mention something in my Facebook group, then that's fair game too. But for now, I think I'm going to focus mostly on the core trend trades, and that'll make sense in another minute too. Warts and all, good and bad. And I'm showing a representative sample. What I mean by that is if I take trades over several accounts, I'll just show trades from one particular account. And usually what I'll probably do, just to keep the math easy, I'll keep it about based on a 100K account. All right, let's take a look at a mystery chart reveal. And this is actually one that just recently triggered as one of the next 100 trades, he tried to say. Anyway, it's AR, and as I showed a couple of weeks ago, it was in a longer term uptrend, doing pretty good, like the rest of the energy stocks. So then it began to sell off fairly hard. This action formed a bow tie. That's when the moving averages come together and then spread out again, giving the appearance of a bow tie. And those moving averages are 10 simple, 20 exponential, and 30 exponential. So the 10 is greater than 20, and the 20 is greater than 30 in uptrends, and then those flip over to downtrend proper order, 10 less than 20 less than 30. And if you plot the bow ties in ACP, it gives you a nice little representation on the bottom. A little graphic helps to kind of illustrate what's actually going on in the chart. So here was the actual trade. AR, we're going to sell shorts. So for every 100K, 286 shares, round that up. If you want to be a little more aggressive, round it down if you want to be a little less aggressive. But that's roughly 2% risk on the account. We're looking for 1% on the first loaf when we take half of those profits. So that'd be $1,000 profit. And then on the second loaf, hopefully much more. So here's the entry, here's the protective stop, and here is the initial profit target. Let's take a look at what's happened since. It did trigger and it began to sell off nicely for a while, but as you know, shorts tend to go against you here and there. What's the old adage? All shorts initially go against you. This one actually worked out pretty nicely in our favor before it retraced back up, but I think there's still hope. So when it did drop a little bit, what we did was we dropped that stop along with the stock. So our risk is a little bit less than 2% now overall if stopped out. Once we hit that initial profit target, and that's wishful thinking, hopefully we'll hit it, a word you should never use in this business, hope, right? But hopefully we'll hit that, and once that happens, this stop will come down to break even. And that allows us to free roll, so to speak, and hopefully stay with the position for a long, long time. And I'll show you one of those in just 1 second. GGR, I skipped the show July 4th, so I wasn't able to put this one out as a mystery chart, but it was in my trading service. And anything that goes in the trading service will go directly to these 100 trades. There may be some ancillary trades I add in, but for now, for the most part, everything is going to come straight from the trading service. Maybe some IPOs might be a good way to help those trades out too, and I'll explain that in just 1 second. Anyway, this was coming off the lows quite nicely, pulls back in here. Notice that it made a bow tie, same sort of action as in the AR, but on the flip side, the moving averages were in downtrend proper order, meaning the 10 was less than the 20 and the 20 was less than the 30. And they flipped over to uptrend proper order, meaning that the 10 greater than the 20 and the 20 is greater than the 30. And that action suggests that the trend has changed. And what you do after that is you look for at least a 1 bar pullback. If you get bored or can't sleep at night, go in and watch the shows we've done on bow ties, and you can find those through the aforementioned slides. Anyway, here's the portfolio, and you can see the setup was to enter at 7, stop at 570, and additional profit target of 830. Now, so far, this one hasn't done so well. So how's it going overall? Well, so far, not so good. Here's a snapshot of the trade, and you can see initially with these, there were some of these intraday trades I was throwing out from my Facebook group. For now, I think I'm going to focus on my core methodology and IPOs, and that's where I make the most of my money, but I do occasionally take some of these ancillary trades and some intraday trades too. But just to stay sort of as true to the methodology as possible, I'm going to stick mostly with core and IPO trades from now on, with a possible exception of an ogre here and there. Now, the flickering ticks, as I said a few weeks ago, on an opportunity cost basis, may have cost me about $3,500 because there was a really nice IPO, and I was busy chasing some of these other things and not paying attention. So shame on me, or as I used to say, shame. Someone actually sent me a bell. Let me see if I can find it real quick. It'll be great when we go live again to show these things. But the bell says shame, and like on Game of Thrones, because I used to say that quite a bit when I do some things that I should. And by the way, it's probably good to track your shame, so to speak, trades or things that you shouldn't do or mistakes that you make. Now, so far, no big trades have come in as far as the core methodology is concerned. We're making a little bit of money on AR so far, knock on wood, although that did retrace as I showed earlier. And the GGR, though, so far is killing us. It initially moved in our favor, but then it's backed off from there. Now, the big money is in the longer term trends, and that's once you get that swing trade profits out of the trade, and then your stop goes to break even, as I said a second ago, and you're trailing that stop higher. And I'll show you another example of this too. But you can see that we got 20% in the first loaf on this, and 308% so far, knock on wood, on the remainder. And that's where the real money is, and that's how you make a lot of money. Now remember, this is a hypothetical 100K account, although I do actually take these trades, but for tracking purposes and for legal purposes, it's all hypothetical, right? But anyway, 60% move on the entire account is not bad. Better than poke in the eye. And that's what the real money is. And I'll update you on these as they show up. I want to do a really brief 10% system update and a couple of random thoughts on that. Here's the buy line, and the buy line is simply 10% below the 52-week closing high. Now, this is a weekly chart. And this indicator, if you want to call it that, or just the illustrators I tend to call indicators, just kind of tell you what's going on in the charts, lets me know that the market has dropped more than 10% from its highs. And down here, it shows you the maximum move from those highs. So from the highs, peak to trough, we've gone 22% so far. Now, as I've said quite often, borrowing a line from Mr. Baleo and Gaird, they said that, and I believe they were talking about the 200-day moving average, although I can't find the article Somebody mentioned it. It might have been Charlie Kirk or it might have been Dave Keller. But anyway, they wrote an article called "Where Bad Things Happen." They actually won an award for it. And their point was that once you get below the 200-day moving average, there's some bad things that can happen in the market. Well, in this case, I have the 50-week moving average, which I guess would be a 250-day moving average if you look at a daily chart. And along the lines of their thinking, anything below the buy line, and especially if it's below the buy line and the 50-week moving average, which would signal a sell signal, as we had just recently, that's where bad things can happen. And the whole designer's intent of this particular system was to avoid the occasional diaper change moment. That's a line I stole from Ian McActivey. He's no longer with us, but boy, he was a great guy. Did some really great presentations. He's a fellow member of the American Association of Professional Technical Analysts. At least he was. Anyway, you can see we did close below the buy line and close below the 50-week moving average, which signaled a sell signal. And so far, peak to trough from there, the market has dropped 15%. And as I said last summer, I think it was around the 25th or 26th, I pointed out that no one calls me when the market's making new highs, but once they're down 30 or 40%, my phone begins to ring. So my phone's beginning to ring now, so I don't know if that's a sign that we might be closer to a bottom, or at least closer than we have been in a long time. But anyway, the reason I did that show on market timing when the market was at new highs, again, is because nobody calls me when everything's going well. And if the market is down about 10% and we start seeing some of these sell signals trigger, you might be able to get out the way before something really bad happens. And again, that's why I did the show when the market was making brand new highs. I think a little market timing is better than none. And I think, like I said a second ago, where bad things happen, you have to have some sort of performance metric on a chart to know where you are wrong, or at least know where you should get out of the way. And I think the 10% buy line, the 50-week moving average for a longer term trend following and longer term market timing, I think those are pretty good metrics to use. And now keep in mind that you might want to pay attention to daily signals too. But one thing that did really impress me was during the pandemic, the weekly signals actually triggered before some of the daily signals, such as the bow ties, caught up to the market. Now, shifting gears, like I said last week, I've been asked by a Chinese investment forum to do a presentation for them. And they really want me to focus on the methodology. And I tried to explain to them that really you got to get your mindset right first before you get into methodology. And of course, money management is important. It's like everybody has this flip the wrong way. Everybody's a setup junkie, wanting to know the latest and greatest setup and all that. And I get it, and I am too. But the trading psychology and the money management are also crucial. So I agreed to focus on the methodology, but I was going to sneak in a little bit of money management and psychology. And I just want to kind of go over this. I know we talked about this last week. So basically, this is the whole methodology in a nutshell. I did put this on a cocktail napkin. I think Dave Keller has mentioned this before. And if you ever see me in person, I pass these out when I speak. And this is pretty much the entire methodology in a nutshell. And we talk about it quite a bit, but the methodology in general is a pullback-based methodology. We put in a stop in case we're wrong. We put in an entry above the market to make sure the market is moving in our favor. And if we get that swing trade out, we take an initial profit target half, and then we trail a stop higher. At that point, we're free rolling. So I mentioned this one last week. This is that aforementioned ARLP. We're still in this one. Entry was here. The stop was down here. Initial profit target was right there. We took off half of the shares. And then ever since, we've been trailing that stop somewhat loosely. And a lot of times, you're just not doing anything. Let's say the stock goes up 20 cents or something now, especially now it's up here around $18, $19 a share. You just don't do anything on days like that. And other days, let's say we're blessed that it goes up 2 points into brand new highs, we might only raise our stop 1.5 points to sort of naturally, so to speak, allow that trailing stop to open up. And the idea is to ride out a longer term trend. Now, you'll notice some big old corrections in here, and these lasted months, okay? And if I were coming in and seeing the stock right around here somewhere or going sideways or kind of rolling over a little bit, there's no way in the world I would take this as a new position. But if we have been in this for a long time and we're just trailing that stop higher, then I'm willing to ride at those long corrections. And that's where the real money is. By the way, somebody asked me once if my money management was psychological or psychologically based or monetary based, statistical based, psychological, statistical. And my answer to that was yes. And the short term profit taken kind of gives you that, not to go all freshman psychology on you, but kind of the Maslow's hierarchy of needs, that need for instant gratification that we have in this microwave society. As I said 100 times, it's like, bought the new house and everything's new and everything's going to work great, right? Our microwave sucks. I know you feel sorry for me, first world problems, but we're the worst microwave in the world. And it's like, it's amazing, like, oh, this thing takes 2 minutes. It should only take 1. It's like you feel like you're losing that minute. You want that food to be ready right away. But anyway, this so-called microwave society that we're in, all these pressures to perform and to have something happen right away can really, really be tough. And that's kind of where the taking the partial profits come in. Statistically, though, you're more likely to get that partial profit than you are some great, fantastic, longer-term trend like this. In fact, if you only do longer-term trend trading, not to digress too far, imagine that. But if you're only going to do longer-term trend trading, you're probably going to be wrong about 76% of the time. And those are pretty tough odds. Who was it? Bart Simpson said, statistics are worthless. 75% of all people know that, right? So again, we're going to let that stock gradually open up over time. And that's pretty much the money management in a nutshell. And you'll see those in the slides and go back and watch the presentations on YouTube. And you can also go to my YouTube channel, youtube.com/c/Dave Landry, and take a look at the weekly charts and also take a look at my quick clips, and you'll see a lot of money management there too. Or become a member of DaveLandry.com and you have the courses and all that you need. So getting back to the money management methodology, one thing I wanted to do is figure out how I could explain trading psychology as quickly as possible, sort of trading psychology in a nutshell. Now, as I said a couple of weeks ago, we all have believe it or not, a pretty much shared psychology when it comes to markets. For instance, the real world and the trading world are two completely different worlds, and I could never understand why so many people who are very successful in life take such mediocre trades. And then one day, one of my clients who was a psychiatrist said, hey, you know what, Dave, I think I got the answer for you. In our lives, we're forced to take whatever train wreck comes along. And in her case, she can't wait for the perfect patient to come along. We can't wait for that perfect pitch. So she has to take whatever train wreck comes along, try to fix them, even if trying to fix them could do more harm than good, you know. And the same thing goes with an automatic transmission mechanic or anyone else who wants to stay in business, at least stay in business for long. You have to take whatever comes along. In the trading world, you have to wait, which is the polar opposite of the real world. And that's where, like I said, that shared psychology comes in. Now, you could debate one person has a different personality than another, and of course they do, but we do have a bit of a shared psychology when it comes to the market. And I think it's important to talk a little bit about neurology. And one epiphany for me when it comes to neurology was about 10 years ago now. I was speaking in San Francisco, and Denise Shaw was talking about some of Damasio's work. And the bottom line is that it's impossible to make a decision, and that's any decision. An example I often use is what you will have for lunch without emotions and stress. And a stupid little example, but right before I'm recording this, I'm thinking, okay, let me grab some lunch and then record this. And then I got to thinking, well, if I eat, then what if the food doesn't settle well? And I'm burping in my presentation and all. So some stupid little decision like lunch has a lot of emotional consequences. And the way they've proven that this is the case is those individuals who have been unfortunate enough to have illness or injury to certain parts of their brain can no longer make any decisions because one decision doesn't have a consequence over the other. One decision doesn't have emotions over the other. So you're often told to eliminate your emotions during trading, but you cannot make decisions without emotion. So every decision you make will have emotions and stress attached. And this is especially true, obviously, in trading. Little Captain Obvious statement there. Now, what's interesting is not only are emotions needed to make decisions, if you don't have feelings attached to that decision, you're going to make a really, really, really bad decision. Now, the study was done on the orbital frontal cortex, which is known as the loss avoidance system. And people who have damage to this area, who are unfortunate through illness or injury, they don't make very good decisions. They gamble a lot, and they tend to just make flat out bad decisions, especially when it comes to risk. So this is where your feelings about losses come from. And you know, this morning I got whacked on something, and I was pretty bummed out. But I just have to embrace the fact that, hey, Dave, if you're not bummed out about those losses, you're going to keep making those same mistakes. So Damasio's research implies that people need feelings to signal when to avoid losses in risky environments. And that comes from The Investor's Brain. That's a book I would recommend you read if you want to learn a little bit about neurology. I know you probably want to party with me. So the bottom line here is that you need to embrace and accept the fact that you need emotions and feelings in order to trade. So you really have to embrace your emotions. You really have to embrace your feelings. Now, one thing that I was thinking about too when it comes to psychology is like, what else do you really, really, really need to know? Well, you need to know that when you buy a stock, you're forming a relationship between you and the company, and you're expecting that company to do great things, and you might feel great about the company and have all these feelings towards the company or emotions towards the company, thinking that, hey, you know, this is a really, really good company. I'm going to go ahead and buy this stock because I like the management, and the management's going to do some really, really, really good stuff. Well, anyone who bought the stock prior to you has also formed a relationship with that company. And quoting Tom McClellan, and those people will screw you. Okay? So those people, the bottom line, this was a speech he gave a few years back at the American Association of Professional Technical Analysts meeting in New Orleans. And his point was that the other people are a lot more important to your trade than the underlying company. As often is said, as traders, we're trading traders, not markets. And that's hard for people to wrap their heads around, but it's something that makes a lot of sense. And I've quoted Tom over and over again. If you've known me a little bit, you've probably seen what I'm talking about now. Like, come on, Dave, stop beating the dead horse. Well, I'm going to keep beating the dead horse until you people get it. And also until I get it. You know, sometimes I make mistakes, obviously, too. So I told Tom, it's like, you know, I really like what you said, and I've been using the heck out of it, kind of beating the dead horse with it. And he says, I'll do you one better. Here's one from my late mother, Marion. Everyone uses timing in their investing. Some people buy when they have money and sell when they need money, while others use methods that are more sophisticated. In my longer course that I did on trading psychology, I talked about a buddy of mine, Dick Fruth, who runs a bunch of money. He's over in Houston, Texas. And he's been around for a while. And when he first started as a broker many, many years ago, before he became a money manager, back in those days, people would actually bring in their shares. And a lot of the curmudgeons, I think is what he called them, would just rip the shares out of their hands. That's back when you actually bought stock and you actually had the shares delivered to you. Would rip the shares out of their hands and take their order and send them on their way. And Dick's a little bit more gregarious than that. And he would chat him up a little bit, and he's like, "Hey, why are you selling the stock or whatever?" And they're like, "Well, I'm getting married, I'm getting divorced," or it's like, "Why are you buying this?" "Well, I was left a little money, I want to buy some stocks," and so on and so forth. And along the line of Tom McClellan's reasoning that people buy and sell for a variety of reasons, many of which have nothing to do with the underlying company. So always ask yourself, and this is something that I do every single day of my life, at least when the market is open, and then when I'm doing the postmortems too. It's like, are you buying this because you have money? Or are you selling because you need money? Or is it any other reason that has nothing to do with trading? Say you have a fight with your spouse or significant other or both. I mean, who am I to judge? But that can really mess up your trading. And the other thing you ask yourself is, am I doing something far more sophisticated? And the main question you need to ask yourself here is, and is that what I should be doing? Well, it looks like I'm already out of time. Whenever I get to talking about trading psychology or neurology, I know you want to party with me. Time seems to fly. I'm going to pick this up again next week. I want to show you some things that are going to help you tremendously in this process. Some really, really simple things. And maybe in upcoming webinars, we could do a little bit deeper dive on some of these things. Again, if you need to reach me, DaveLandry.com/contact. If you want the slides from this presentation and a plethora of information while trading, go to DaveLandry.com/StockCharts. Get to know me first to see if you like what I'm up to before you spend any hard-earned cash. I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.